Hello, everyone. So this video is about the expected ranges and ideal ranges that the bank is going to want to see on your deal. We've gone through now how to calculate all these different covenants, and I've left out some of them because these are going to be the primary four that the bank is looking at to determine if your deal is bad, decent, or great. All of these are done on a pro forma basis, meaning post transaction. So whether that be you're new to the market segment and you're buying this business on a standalone basis, or you're combining it with your existing business, the bank is going to take all of the information that we have collected or you have collected and submitted to the bank, and they're going to do cash flow analysis and balance sheet analysis and going to find the answers to these metrics. And then again, based on where all these metrics fall in, and you're of course not going to be great on all of them. Some you might be decent, some you might be bad, some you might be good, but it just depends on how you look across the board, and then based on that and these metrics, whether the bank will feel comfortable moving forward or not. So let's go down the list here and talk about it. Of these are not, I want to preface this video too by saying these are not the end all be all. Some of these I would argue aren't even necessarily correct. For example, that fixed charge coverage ratio of 1.25 in the bad realm. Um, it would be very hard to get a deal approved if you were less than that. Now, I'm not saying it wouldn't happen, but you would typically need to be in that decent range always on these cash flow covenants. But I wanted to provide you with what the bank would see as bad or too leveraged, or they're just not going to get comfortable with it, just so you know kind of the line in the sand where the bank's going to balk. So, let's go through. So, debt service coverage. So, debt service coverage is going to be, you need a ratio higher than 1.35. I would argue 1.25 is typically the covenant, but in order to get the bank committed to doing this merger or acquisition that you're doing, and you have to remember these deals are the most risky or some of the most risky because there's execution risk, there's integration risk, there's all these unique risks that go along with these deals where the bank is going to want you to have cushion. And that's going to go with all of these. The bank is going to want you to have cushion where if something goes wrong or you can't ramp up cash flow fast enough, that you have enough runway to save the day here. So, your debt service coverage, and I'll even talk fixed charge coverage right now. You need to get those above these 1.35 and 1.25 levels. You're too thin at that point, and I would even say to you that you should be very, very careful proceeding with any of these deals. You're already razor thin, and unless you have a great story and a great way to ramp up cash flow that's going to blow this out of the water, you want to be very careful doing these, especially for mergers and acquisition deals. So, moving across now, we get into the decent range. Now, decent, I would say, is good, very good. What you would expect to see 95% of the time. The bank will not balk at these. They will assume that it's a good deal and they won't really question it, especially the more you get up to that 1.75 and 1.65 range. The bank is going to go, hey, this is a good deal. We should do this deal. They're basically going to look at it, confirm it, and then not necessarily glance over it, but it's not going to be something they're going to hold against you. No one's going to get fired for approving a deal with a debt service coverage ratio of 1.6 and a fixed charge coverage ratio of 1.5 on a pro forma basis. It's just not going to happen. The underwriter, and again, this is what I did in my past, the underwriter is going to be all over it. And I mean, that's a pretty healthy bit of cushion to make sure that you're going to execute. So, those are decent ranges. And what I mean by decent again is the bank is not really going to balk. They're going to move along. They're going to go, great. These make sense for us. They're middle of the road. They're not the greatest I've ever seen, but they will not hold you up or not be an issue. And then now we're getting into the great range. Again, this is for debt service coverage and fixed charge coverage. If you have a debt service coverage above 1.75 or anywhere close to that 2 range, and same with fixed charge, if you have it above 1.65 or anywhere close to 2 range, the bank is going to love it. They're going to have a very hard time saying no to your deal. The things that will hold it up in that situation are going to be the company is too over levered, but even then from a cash flow basis, you're not. It would be a balance sheet leverage situation where you either don't have enough money in the business or something along those lines. But those are going to be creme de la creme deals, the cream of the crop, the best of the best. And the bank is going to love those and want to do them. They're going to be all over those because it makes sense on paper day one. You have plenty of cushion. You can deleverage the company very rapidly based on the numbers you're putting forth. And you just never really see those deals. I mean, the amount of times where someone has come to me with a great idea and they've had a debt service coverage or a fixed charge coverage anywhere close to two, I don't think I could count them on two hands. So those are the ideal great situations. And if you can find a transaction like that, don't tell anybody about it and make sure you present it to somebody because most likely it'll get approved. Okay, so now we're going to move down into a quick balance sheet one. Now, funded debt to EBITDA, which is below this, is also a cash flow leverage covenant, but we'll do the debt to tangible net worth covenant here real quick because this one's pretty straightforward. And again, usually everything on your balance sheet is lower of cost or market from a fixed asset basis, which is where a lot of the tangible net worth is going to be. Also, too, um, and that's excluding intangibles because this is tangible net worth. We're not talking intangibles. We're not talking goodwill or any of those other things. We're talking fixed assets, and then also too, all of your current assets, which are receivables, inventory, things that are held I believe at fair value or at cost, and it's very hard for them to write down because you get rid of them very quickly. So, again, these are balance sheet covenants. So, if you have debt to tangible net worth of greater than two times, your deal is not going to get approved, or it's going to be it may get approved, but you're not going to be able to get any additional leverage on the deal. The bank is going to go, okay, we're kind of hitting the top line of how much leverage we want to give this company, and most likely, if you're in that range too, unless you, for some reason or another, have a great story or it's a specific case or anything, even from a cash flow standpoint, it's going to be difficult to get it done. But if you have a debt to tangible net worth of above two times, the bank is going to, they're not going to want to extend much more than that. You're going to be fully levered and you're going to have to de-lever the company down to that below two range. Now, that doesn't mean I haven't seen deals with debt to tangible net worth of three times or things of that nature. Typically, though, those are distressed or not the best, and people are having heartburn. So you do not want to be anywhere close. You want to move to the right here and be more in that less than one range, which is great. Okay, so now moving into the decent range, 2 to 1 times again, same thing as the debt service coverage, fixed charge coverage. If you are in that 2 to 1 range, you're good. You can get more leverage up to two times most likely. So for example, say you're doing a merger and acquisition deal, it takes your debt to tangible net worth to 1.5. You most likely can go to the bank and say, hey, I also want a line of credit, and they'll give it to you. Most likely, more likely than not, they'll give it to you. You're not too over levered yet. You still have additional capacity there from a balance sheet standpoint, and the bank will most likely be okay with it. So um yeah, you have enough money, you've created enough value and have enough money in the business for them to be willing to lever it two times to what you have in it if it's a good deal, especially too. And these would also, this type of transaction, um depending on if you have real estate or not, or this type of situation depending on if you have real estate or not, is going to dictate that. But again, yeah, that's getting very in the weeds, deal specific, deal by deal basis, but use these ranges. These ranges are going to be your best bet. So in between 2 to 1, you're okay. It won't hold you up. It might be, if you get closer to two, it may cause some pause, but you're probably in that decent good range. And then the great deals are less than one. If you have debt to tangible net worth of less than one, people will lend to you all day long. You're showing that you have more skin in the game than the bank does per se, and the bank has more enough capacity to continue to lend to you even on a one-time basis. I mean, they're going to want to do the deal. It's going to make sense. You most likely have a lot of money in the deal of your own personal worth, or whatever the business is worth. It's in the business and you have skin in the game, so the bank is going to lean in there, and there's not going to be any issues. Or if there are, it's going to be on a cash flow basis and not from anything that's on the balance sheet. The bank is going to be looking to try and get it done because it makes sense. And again, no one is going to get fired with a leverage profile that low from a balance sheet standpoint. It's just not going to happen. So, yeah, pretty straightforward there. Less than one is the best. Keep it below two. And then finally, back to another cash flow leverage ratio, funded debt to EBITDA. Everyone knows this one. And again, we're going left to right here. So bad, above 3.5 times. And the reason why 3.5 times is really going to be your line in the sand. And this is more for conventional. There might be some SBA transactions or some other specific things that cause it to go higher than this. But if you have a deal size above $10 million, there are strict regulatory requirements that make the bank have to do all these crazy projections and things of that nature. It's called structured leverage transactions, or levered obligors, is what one particular bank that I work for called it. But they all basically have the same thing, which is if you're above $10 million in loan amounts and you have that high of a leverage profile, it's very hard, and it's very cumbersome, and the bank is going to need to tap very skilled employees to do those deals. So they're usually going to shy away from it. I would say that if you have a funded debt to EBITDA above 3.5 times, now, of course, if you have real estate or something on a long repayment schedule, that's gonna change that answer. But again, they're gonna usually look at that um, off of it. They're gonna just look at the operating business. They're not gonna look at your real estate. But if you're levered above 3.5 times, it's very hard to get it done. You're usually not going to get it done, and it's usually going to be less than $10 million from a debt standpoint, transaction wise. All right, and we're moving to the decent range. Yeah, the closer to two, the better in this situation. I even three is pushing it. You really want to be in that 2.5 to 2 range. Is, I would say, a normal decent deal. Even two from the mergers and acquisition structure video. What's the typical repayment terms on a merger and acquisition deal when it's not SBA? It's 3 years fully amortizing, meaning you have to pay for the business transaction in 3 years. So you need to get that ratio down to as close to two as possible. Now, if you're in that three range, again, the bank may look at it, they may take pause, but usually they're going to move forward. They're going to say, okay. But again, it just like with the balance sheet discussion we had, they're not going to want to give you any more debt. So the closer you are to two, the better, because it'll give you more optionality and you most likely can get more leverage from the bank. And then finally, if you have funded debt to EBITDA less than 2 times, not greater than 2 times, that's a mistake on my part. Here, let me change that so we don't have any confusion. Yeah, if you have funded debt to EBITDA less than 2 times, which means based on your existing, proxy for cash flow that you can pay all your debt back in less than 2 years, the bank is going to be okay with that. Um, that's enough cushion. That's enough speed to get repaid where the bank is going to be comfortable. And they're most likely going to be trying to get hung up on something else and not on your funded debt to EBITDA or cash flow leverage. And usually, deals that have high debt service coverage, high fixed charge coverage ratios are going to fall very similar into this great category for funded debt to EBITDA. It's sort of all tracking the same thing, but it's looking at it a different way. So, yeah, I hope you found this video helpful. These are the ranges really that you need to be locked in on. And again, if you can get all of these four things in the decent or great category when you present it, I would argue that 95% of the time you're going to get the deal done. And the only things that are going to hang you up are going to be things that are in the background. What are things in the background? Your experience, maybe there's not enough collateral, but even still, that doesn't necessarily make sense because of the debt to tangible net worth. You personally don't have enough money, or there's some nuancy thing, there's litigation, who knows what. But so if you can get all of these different metrics in the decent to great, you're most likely going to get your deal done. It's going to get funded and you're going to be off to the races. So hope you found this video helpful. This is the end of our covenant discussion for now. I'll do more covenant videos in the future if people want them, or I find other covenants that are great. But this is the main conclusion video on the covenant series. I hope you found it useful. And if you do want me to add any additional covenants, message me. I'm happy to do it. Thanks so much for listening.